Hello everyone, here is a brief discussion of internal controls and why they are important to a business. What exactly are internal controls? They are an organizational plan and related measures that help a company safeguard their assets, help the employees of that company follow the company's policy and work in an efficient manner, and most importantly, they ensure the accuracy of accounting records. What do I mean by internal controls? Well, they're plans that you have for every aspect of your business. Say you need some new employees. You can't just go hiring everybody. Maybe you accidentally hire someone who has a history of embezzlement, financial fraud. How do you find that? You do a background check on them. Maybe you put someone in a position within your company that they are not competent or at least not, educated enough to do effectively, thereby decreasing the efficiency of your company. Well, how do you stop that? You put in a system of training programs. So one control procedure you have is definitely related to your employees. It's to make sure you have the right people in the job and those people know how to do their job. And another important aspect of control procedures, another important internal control, is the delegation of responsibilities. You can't have everybody doing everything. Place would be very inefficient if everyone at the company was required to do a specific job, so you delegate out responsibilities. One person does one thing, or at least a small subset of things. And by having these things separated, people become specialists in what they are working on, which is important for the third thing, which is separation of duties. To prevent fraud, you have to have different people always checking in on every aspect of your business. Give you an example. Say that I was the person in charge of both purchasing at a company as well as checking to make sure that everything that was purchased is actually there once the order comes in. How could I defraud the company? Well, I could order more units than the company needed at the time. Say that I'm paying, the amount to buy, say, 80 units when the company only needs 50, but put 50 units on the books. Well, when they come in, I'm the person that's checking to make sure that everything we purchase is there. Those 80 units would come in, but I could just steal 30 of them and put them in the back of my truck and later sell them on eBay. The company would look at that and say, okay, we bought 50 units, we paid this much for it, everything looks good. It's because there was no separation of duties. So in this instance, you need a separate person in charge of purchasing than the person who's in charge of checking shipments when they are received. Same thing with payroll. You can't have the same person calculating the payroll and writing the checks, because they could just add zeros where they wanted to and get away with fraud that way. So you need to separate out the duties of a business. And lastly, you need to have someone in your company that is dedicated to making sure everything's working properly, and that is your internal auditor. So he or she is an accountant that goes to the numbers that your accounting staff is preparing to make sure, is this in compliance with GAAP? Are we doing this correctly? Internal controls are incredibly important to a business, but they have limitations, and namely that limit is cost and collusion. As far as cost goes, if you have 1 million internal controls, if you have 7 internal auditors to make sure everything possible is caught, well, you have to pay all those people, which means, yes, you are getting better, accurate information and your company's running smoother, but your company's not as profitable as it should be, which is what owners or investors are looking for. So there's a limit to where you have the proper amount of internal controls at the right cost, and that sweet spot is different for every business, but you need to find it. The other thing is collusion. Like I said, we're going to separate duties. We're going to have different people doing different things, delegating out these responsibilities. Well, what happens if 4 or 5 people come together to defraud the company? Well, they can't. They can work in a team, and as long as everybody's in on the plan, you can have financial fraud that way, because yes, the duties are separated out, but everybody's working towards that same fraudulent goal. So you can have the best set of internal controls in the world, but if everybody that's working at your company is committed to defrauding the company, well, then that's not going to work out very well, which is why you do these background checks and you check on your employees. In 2002, a thing was passed called the Sarbanes-Oxley Act. Essentially what happened is we had several major companies, Enron, WorldCom, etc., that committed massive financial fraud and embezzled millions of dollars from investors. And investor confidence was incredibly shaken in the accounting profession as a whole. So two senators, Mr. Sarbanes and Mr. Oxley, came together and they wrote up an act which essentially made it much harder for companies to commit fraud and get away with it. How? Well, now when you issue your financials, those 10Qs, those 10Ks, you have to have an internal control report in there as well. You have to have a report that says these are our internal control procedures. These are the ways we analyze to make sure that they're effective. And this is our report on our findings of if our internal control procedures are working or not. Those procedures need to be certified, as well as the financials, by company management. So company management can't say, well, I didn't know anything about it. That was some of these other accountants way below me that did all this. No, like they have to sign off and say, yes, this is what's happening in our company. And if there is fraud and management misses it, well, management is held liable. It's their responsibility under the Sarbanes-Oxley Act. Another thing, there was a huge change to the Sarbanes-Oxley Act, was that your numbers are required to be audited by an external firm, which has always been true, but now that firm has to be independent of any other function to your company. And what I mean by that is you can't have your accounting consultant be the same company that is auditing your numbers. Why? Because that company in this situation is probably making a ton of money off of consulting fees by consulting for your business. Well, if you try to put out numbers that are sketchy, that are a little fraudulent, what is that independent auditor going to say when they know that if they reject your numbers, they say they're not going to agree to your numbers, then you're just going to go find someone else. They're going to lose all of that money from consulting revenue. So by having, that two-job function that this one accounting company, this one auditing firm is doing for you, it gives them incentive to assist you in, manipulating your numbers a little bit, because it helps their bottom line as well. So you can't have any auditors working for you that provide any other services, and you can't have an auditor that has some kind of direct ties to your company. Namely, it can't be the brother of the person running your company. They have to be truly independent of you. And lastly, the internal control report that I was talking about earlier. What is it? Well, I'm not going to make you read through the whole thing because it can get large. Basically, it is the scope of your internal controls, what you're trying to do, very finite definition of what each record or each control does, and a detail of how you're going to assess it and what your assessment is going to report.